fuel. मेरा
सड़कों से सरहदों तक, पहले इंडियन, फिर ऑयल। इंडियन ऑयल।
For over 140 years, we have partnered India's growth story. A journey from a nation of hardworking farmers and traders to being the global benchmark in industrial development. BSC, experience the new.
मधुर शुगर की 5S गारंटी के साथ चखिए स्वाद मिठास का।
Good morning and welcome to day 2 of the Hindu Business Line Commodity Outlook 2022, powered by Indian Oil in association with Madhur Pure and Hygiene Sugars, associate sponsor BSC, and our knowledge partner NCDEX. I'm MR Subramani, your host from Business Line, and I'm your moderator of the day. I don't know about others, but I am one of those who looks forward to Friday on Monday itself. That really keeps me going, even on Friday, since we look forward to a peaceful weekend with family and friends. It's Friday, and I hope early this morning all our batteries would be charged, and that I hope will ensure a good 2 sessions today after yesterday's session on energy and agriculture, during which a lot was said on what is in store for 2022. Yesterday, we saw discussions on how next year will be in general, where prices can head lower, though there could be an exception or two. We heard how Omicron variant of coronavirus could be a factor in the prices of crude oil and other commodities. On the agriculture front, we heard how ethanol is changing the face of Indian sugar sector, as also sugarcane growers. We also heard how there is some headroom for cotton to rise, but it could head lower towards the later half of the year. Palm oil could also zoom to record high next year, was another view. So this morning, we hear that palm oil has dropped to 11-week low. Now, getting on to business, we started the day with the outlook for gold, which has been up and down this year. As of today, despite being about $1,800 an ounce, gold has dropped nearly 5% since the start of the year. Silver is almost down by 15%, platinum over 12%, and palladium almost 30%. Half of gold consumption in the world is in jewelry, 40% in investment, and 10% in industry. India is the largest consumer of gold, what with most of the Indians lured by the yellow metal. One of the features of precious metal trading is that gold dictates and decides the direction of prices of other elements too. Last year, gold hit a record high of $2,048 an ounce, and this year, after ruling about $1,900 in January, it has been volatile. Analysts say the volatility is likely to continue. Developments with regard to Omicron and geopolitics could play a crucial role next year. What then are the prospects for bullion next year? Let us hear it out from our panel of experts. We start off the day with Mr. Somasundaram PR, Managing Director, World Gold Council, with a special address. Mr. Somasundaram has been with the World Gold Council for over 8 years now, leading the council's activities in India. He has over 27 years of experience across diverse industries, including FMCG and banking sector. Before joining WGC, Somasundaram was the Chief Executive Officer of Lakshmi Vilas Bank, a private sector bank. Prior to that, he was part of Standard Chartered Bank in India for over 8 years in various senior roles before taking on the role of Managing Director of Standard Chartered STCI Capital Market, the security arms of Standard Chartered Bank. He has also spent over 13 years with Hindustan Unilever in a variety of roles, as well as working for Tata Consultancy Services. He is also a qualified chartered accountant. He is also an avid reader of BusinessLine, and he has got great contacts with one of our reporters who had earlier worked with Coimbatore. So it's a long relationship that Mr. Somasundaram has with BusinessLine. Now, over to Mr. Somasundaram for his. Welcome, sir.
Thank you very much. Very good morning to all of you. It's definitely, I don't know, MR, what you say. Friday is always a great day, even Monday is. And particularly these days when you can come to office, it seems like, the world is opened up. So I enjoy this, and I'm definitely my best wishes for this conference as well. I'm glad to be the speaker for the day. Well, as we talk about gold, let's talk about 2021 before we move on to 2022. 2021 has been a roller coaster year for the gold market. If you really see, it started off very good in the first quarter, January to March, prices softening up, and people soon after a good Diwali last year, and slowly things opening up. Industry expected that it would have a very good Akshaya Tritiya, but that was not to be. We straight away went into another series of lockdowns, although they were not as broad-based initially as they were last year. It slowly spread, and we all know what happened. It was definitely one of the quarters that we would all like to forget for various reasons. Then came the third quarter when vaccination rates improved and people started getting a hold of this pandemic, and things started opening up, and we saw that the demand again picked up. It also coincided with the fact that the gold price softened up, but a lot of the demand that was latent in the last 15 months started coming back, and we saw it in a big way, nearly 47% jump in the third quarter demand. And that was leading to a lot of expectations about fourth quarter, which actually played out very positively. Again, starting with Dhanteras and the spate of festivals that we saw, particularly the weddings that we saw, actually gave a huge impetus to demand. What we know anecdotally, we still don't have the quarter four figures, but looking at the import figures and what we hear from the trade, and also looking at the buyer to B2C, as they say, buyer to seller meetings that we attended, quite a few this quarter. I think this has been one exceptional quarter for gold. As I said, a little softening of the price, bringing it below 50,000 was also one of the chief reasons. And more than that, in August 2019 is when we saw the gold price actually inching up. That was much before the COVID lockdown of 2020. And we really saw even 2019 was a very, very soft year in terms of demand, because people did not accept the price of 50,000. They were just waiting in the fringes and expecting that this is probably a blip. But what has happened in the last 18 months, despite lockdown, etc., is that the price point of 50,000 has got accepted by the consumers. And that's what we saw, because while it touched 55, 56, it came down below. And therefore, any price below 50,000 is now seen as a bargain. So that's very good for the industry. Now come back to what we see in 2022. Well, 2022, as we see it, has got a lot of factors that might impact demand. Primary thing we expect is that it will be one of the best years, even pre-COVID. It's probably one of the best years, following on from an excellent Q4 of 2021. But it's always very difficult to forecast a full year without knowing what the other factors are going to be. We have always seen that gold performs very well when incomes start going up. And that's a long-term study that we have seen, that gold reacts more positively to income than to any other factor. So when incomes go up by 1%, gold demand goes up by 0.9%. Whereas when prices go up by 1%, demand goes down only by 0.5%. So this indicates that the income has an overwhelming influence. And with the kind of growth that we are seeing, we believe that it will be a good year for gold. And also the fact that people have now come out, they have more savings, they have less to spend on other spends like travel and others, is going to actually benefit gold. And this is something which we also heard anecdotally from various jewelers, where they said people are buying more for weddings these days because they have nothing else to spend too. The number of guests are limited and the expenditure you can have on various other stuff is limited. The money is all flowing into gold. And the price point, as I said, has got accepted. But clearly, we need to keep a tab of a few things. What's going to happen to the price itself? If the price softens further because of rate increases, as you know, the gold price is essentially determined by what happens to the interest rates, particularly in the US. While consuming countries like India and China do count very much in the global scenario, in the short term, they don't influence prices. They react to prices. Demand reacts to price in the short term. But in the long term, demand is a very important factor of price. In the short term, interest rates, particularly US interest rates, determine gold price. So we need to see what happens to that. And if gold price softens further, the conclusion will be, yes, Indian demand will go up because Indian prices will soften up. But that's not such a straightforward equation, because if the rates go up, then what happens to the rupee dollar rate? Therefore, what happens to India price? This is a factor to be kept in mind. So it is not so straightforward to say that if the international price softens, India's price will soften and Indian demand will go up. I don't think we can read it so straightforward that way. The next factor that we need to keep in mind is the domestic one. There have been a lot of developments this year in 2021. Biggest changes have happened. Mandatory hallmarking has been introduced. So that's a very, very big development. For those who don't know this industry, again, they may not see the impact of this, but this is a huge development. It's going to bring back trust. The next one is the announcement by SEBI about a spot exchange, about the electronic gold receipts. Now, they are still at this moment in the realm of discussions. The framework is out, but it is likely to get introduced in 2021. Gold, that is electronic gold receipts, becomes a financial security. Now, that again has huge implication beyond just 2022. And while I still believe, like any other big change, there will be transitional problems, there will be teething problems initially. Introduction of electronic gold receipt and making gold a financial security, spot gold, is going to change the industry tremendously. Now, what impact does it have immediately on demand, on bullion trading, on imports, on recycling? It's very difficult to estimate now, but we believe this will drive recycling in India into the organized space in a much, much smoother way in the long term. So, but that again is a big change that we need to see, very transformative. So hallmarking is there, we have exchange, and of course the international bullion exchange. I'm not talking about that because that's more international, but it will have its impact on India. What it all says is, it is a determined effort on the part of India to play a bigger role in the global market. So at some stage, definitely we will bring the synergy of demand to influence the price. Now, it's not going to happen in 2022, but as you piece all the reforms together, you're able to see that now there is a determined effort to make gold play a much better and a bigger role in the mainstream financial system. Therefore, I will end by saying that we expect demand. As I say, it is a ceteris paribus condition, other things remaining the same. We expect 2022 will be one of the best years. For those who don't know, even before COVID, the 5-year demand between 2015 to 2020, even if you take the 4 years, has been nearly about 150 tons below the 5 years previous. 2011 to 2015, if you say, the average demand was 850 tons. Post demonetization and introduction of GST and introduction of PAN card rule, etc., we have seen the demand drop to 700 tons. So it's not just a COVID phenomenon. It has to do a lot with the various reforms and the transitions, etc. We believe that 2022 will probably push it back to the previous levels. So this is our expectation. We don't forecast prices. So as I said, there are impact on prices from the US interest rates, but that's on the global price. We also need to see what that interest rate does to the dollar rupee rate. Therefore, you got to take a different view of the Indian price and then probably project the demand. So I would leave it with that, and probably at any stage, if there are questions, very, very happy to take it. Over to you, Mr. Subramani.
Thank you very much, sir. Again, Mr. Somasundaram has a lot of views on gold and very interesting views that he has shared with us, and they're all pretty useful, and I hope they'll all be useful for all of us. Now, before we go on to the next speaker, I would request all those who have tuned in to kindly send in their questions, because we have a question and answer session where we have the panelists as well as Mr. Somasundaram taking on the questions. So kindly send in your questions with your name and designation, because yesterday we had some questions, but most of them didn't say which organization they represented. But even if you're an ordinary reader or an ordinary BusinessLine subscriber, that doesn't matter, but kindly let us have your details. Now, we now invite Mr. Pinakin Dave, Head Commodities BSc, for his comments on the fundamentals of the precious metals. Over to you, Mr. Dave.
Good morning, everyone. I'm really thankful to the Hindu BusinessLine. Am I audible?
Yeah, we are audible. Thank you.
Thank you. I'm really thankful to the Hindu BusinessLine for giving us an opportunity to come here and talk to such an elite audience. Speaking on the fundamental factors, and as Mr. P.R. Somasundaram rightly said, that gold per se has emerged more as an asset class, and India being one of the dominant players in the space as far as the consumption is concerned. Now the time has come to entirely change and get into the paradigm shift of the way we used to invest in gold. SGB is one of the most important instruments which has derived in the recent past years, wherein BSE has been very, very instrumental in collecting the money and being one of the agencies. The movement of gold depend on various fundamental factors such as the jobless data, the inflation numbers, the manufacturing numbers, the home sales numbers, and the most important movement that one can see in gold is because of the currency movement. USD INR plays a very, very important and vital role. Many a times you might see that there is no movement in the global markets, but here in India, because there is a movement in the USD INR, you might witness some huge movement in the prices of gold. And here a trader, a speculator, a hedger can come and access the BSE platform and hedge himself on our platform. BSE offers the trading platform for futures and options for currency derivatives. And though we were the late entrant, we started our currency derivatives on November 29th, 2013. But we've been able to garner a sizable market share, a decent market share of more than 45%. The average turnover, the daily average turnover in the currency segment is around 27,000 crores, with futures clocking around 11,000 crores a day, and rest being contributed by the options. The beauty here with BSE is that not only we are the world's best and the fastest exchange, but here at BSE we firmly believe in adding the value to the existing ecosystem, and we have commenced our journey by reducing the transaction charges, so that everyone knows that hedging is an integral part of the business, because the businesses are now wafer thin margins. But here the intent here with BSE is that we charge the lowest as far as the futures or the options transactions is concerned, transaction charges are concerned. So the future transaction charges that BSE levies is as low as for 22 rupees per crore, which is lesser than 1/4 of the what the competition exchanges charges. Again, same goes for the options as well. So the intent here is very clear, to give you the best of the best technology at best of the best possible rates, so that the markets can grow, and it grows horizontally and vertically. So you have a substantial growth as far as the growth numbers are concerned. BSE offers online margining, no counterparty risk is there. So as far as comparing an currency trading platform is concerned, definitely exchange derivatives are more safer, because there are no counterparty risk. Multi-leg orders facility, straddle orders, all are provided by BSE. So as far as technology is concerned, the platform is concerned, we are the best of the best Deutsche Börse technology, which is offered at such a low cost. So this was a brief on the currency, which plays a very, very important role as far as movement on bullion markets or gold and silver markets is concerned. And for that, BSE definitely becomes an exchange of choice for the traders and the hedgers, because of the volume. You have the liquidity, you have the volumes. Vis-a-vis, you have the depth also. So the depth comes to you at a low cost. Similarly, as far as commodities is concerned, we started our journey in 2018 on 1st of October, when we were allowed to launch our commodity segment. So I'm really thankful to the regulators for allowing us, and not only allowing us, but also allowing us to launch unique products. Like last year in 2019 20 Jan, we had approached the regulators with a unique concept of options in goods contract. They not only allowed us to launch the contract, and today we've been seeing BSE as is the first exchange to witness deliveries also in this contract. And now the uniqueness of this contract is, it replicates your futures contract, and not only it replicates, but it replicates with a very, very minuscule cost, because it is options contract. So here the CTT is levied or is charged only on the premium which is traded. So here it becomes a replica or a replacement for trading futures. Vis-a-vis the volumes that we've been able to see a very, very positive response as far as the traders are concerned. We've been able to garner around 4,800 crores a day. So in a span of almost 18 months, we've been able to see these numbers. Not only the numbers are very important for a trader, this number signifies that there is enough liquidity and depth as far as the markets are concerned for everyone. But along with this, the most important and the integral part is the deliveries also. So BSE has witnessed deliveries in almost all the expiries since the launch of this contract. And we are the first exchange to witness deliveries also in BIS, BSE BIS standards of gold. So here again, one more value addition in the existing system by way of launching the India Good Delivery Norms, which is approved by the BIS. So we have launched that, and we have witnessed deliveries in our contracts in that segment as well. So not only a trader is assured of LBMA, but also he can be assured of the locally refined gold bars, which are available on the with the empaneled refiners on BSE. Currently, we have 4 empaneled refiners with us, who are empaneled as to give deliveries on the platform. Along with this, we've been trying to add more value to the existing ecosystem of the commodity space, and we've been doing it by adding or launching new contracts to the basket. We have launched almond amidst the lockdown last year. We all have seen how the tough year was, but in the middle of all this, we were able to launch almond contract, again the first in the world, which is launched by any of the exchange. And the delivery numbers of the entire year have been to the tune of 228,000 kgs. Yes, you heard it right. It's 228,000 kgs of physical almond have been delivered through the exchange platform in a span of 15-16 months. The average volume that is being clocked on the exchange platform is to the tune of around 5 crores. The highest volume was to the tune of 6.5 crores. It is a newly launched contract, and we are seeing very positive response on this as well. The only exchange in the world to have to offer you a futures trading platform for almonds trading. Thereafter, we've launched steel futures contract and cotton J34 contract. Steel futures contract, again, we've seen deliveries. This contract has been launched in the month of June itself, and we have seen deliveries in 3 expiries out of the 4 expiries that have taken place. So here the intent is we are trying to build a new ecosystem for the markets, for the stakeholders, so that more and more people can come explore this contract and trade on the commodities platform that is offered by BSE. We have launched cotton J34 contract, again a unique contract which caters to the traders or stakeholders of the northern part of India, and which is consumed more by the millers of the northern part of India. So this is a very unique contract in terms of the quality in comparison to the existing contracts that are available for the stakeholders to trade and hedge. So the attempt here at BSE is to try and add more value to the system, and to build the more the ecosystem for the new contracts as well. So this is in brief. Again, for steel futures contract, we've been able to garner or do a decent volumes. As far as numbers are concerned, we've been able to do a rough daily average volume of around 5 crores a day. And if I compare it in terms of number of lots, it is roughly around 2,500 lots which are daily traded on the futures platform. Again, a very decent number as far as a newly launched contract is concerned. And as far as turmeric is concerned, again, we've been doing roughly a volume of around 6 crores a day, or 1,400 lots a day for turmeric futures as well. So this is a brief on what BSE is doing all about, and why we are here. So the intent is very clear, to try and add more value to the existing ecosystem, but to add value with a minimal cost, because hedging is important, but minimizing the cost of hedging is also equally important. So the attempt here is to minimize the cost as maximum as possible, and to give the best of the best platforms for the hedgers and the traders which are coming to explore the commodities markets. Thank you very much.
Thank you, Mr. Dave, for that great insight of what BSE is doing on the commodities front. Now it's time for the technical analysis, folks. We have our BusinessLine Research Bureau's senior research analyst, Akhil Nalamuthu, who will make a presentation on how gold is likely to behave next year through his technical analysis. Over to Akhil.
Hello, hi everyone. Hope I am audible to everybody. So
audible, Akhil. Go ahead.
Yeah, sir. Thank you. So I'm starting with the presentation straight away. So here we are going to look at how gold have performed the current year. Just for an idea, see, we can see that gold and silver has clearly underperformed equities. This is largely due to the risk-on sentiment that emerged during the final part of 2020. From August 2020, the precious metal prices have been dropping. So that has contributed in 2021 also. But I want to assure that this does not have any implication on how it is going to perform in 2022. So let us have a view on chart what it says. So when we look at the long-term trend, say from 2000, The long-term bull trend is very clear, and we can rest assured the even the recent correction is to be frank, it is very non-significant compared to the overall long-term uptrend. So the long-term trend, or the when from the perspective of long-term investor, there is nothing to worry as of now. So taking a closer look, what has happened over the past few years, I mean, especially from 2019, we can see that in 2000, until 2019, right from 2013, gold has largely been moving in a consolidation. It was in a consolidation phase where there was no definite trend. But in 2019, as we can see here, there was a solid breakout of this crucial resistance band, as we call between 1360 and 1400. From then on, gold was really performing well, and it carried the positive performance in 2020 also. But come August 2020, after hitting a lifetime high of around 2075, there was some weakness creeping into gold. As we know, economy started to unlock and vaccination rollout were at a good pace. So investors started chasing risk. So gold lost its appeal. But still, if we look at how it has performed in 2021, it has not really gone down much. In the sense, I would say that it has been moving in a sideways trend, largely between 1680. You can see here, this has been a strong support. At the same time, 1920 has been resisting the move upward. But going forward in 2022, assuming that the long-term uptrend will stay, and of late we have seen the news about US rising the interest rates and faster tapering, but still gold is able to sustain above the 1680 support. So considering that the overall trend is bullish, and this support has the support band of 1680 and 1700 has held well. In 2022, we expect gold to be bullish. But as we can see, there is a resistance here at 1920, which may hold maybe the first half of 2022, but we eventually expect the gold to break out of this 1920 and possibly reach 2075 before the end of next year. So to summarize, I would say we are positive on gold. It could give a return of around 12 to 13%, and in terms of price, we expect it to inch upwards gradually towards $2075, which is the previous high. A rally above that, we are not sure. We have to see how things unfold as we go into 2022. So similarly, we take a look at how silver has performed, and this is the long-term trend of silver. Apparently, we can see that it is not as bullish as gold. Gold made a new lifetime high, whereas silver was far below. If we see this high of around $30, it was well below the $50, the high which made in 2011 or so. So the long-term trend is not as bullish as gold. But interestingly, if we see the trend from 2013, from this point till 2019, or so to speak, until now, it has closely matched the price movement of gold. So, so this is how it broke out. This was the resistance which had been holding for years, which is between $19 and $20.25 an ounce, which eventually got broke down in 2020, and we saw a huge rally here. But again, like what happened to gold, it could not go beyond a point once the risk-on sentiment crept into the market. And in fact, silver underperformed gold, so to speak. Silver is down by 15% as of now for the current year so far. But going forward, we do not see much depreciation from here, because as we can notice, a strong support at $21.6. So a break below this level is less likely. Even if there is a break below of 2160, we have a strong support zone here, as you can see in the chart between 19 and 2025. So in any case, we either expect the gold to pick up and rally from here, or even if it sees a small depreciation, it should not go below $20 is what we expect. But on the upside, we see a cap at $25.4 an ounce, which can act as a strong resistance. So before the end of the year, we can see silver touching this $25.4 an ounce. If the bullish momentum sustains, or if the momentum gains traction, we can see it go to $28, but that is very less likely. But $25.4 is very much a possibility. So to summarize 2022 projection, we are positive on both gold and silver, and we expect the price to be for gold to be around 2050 to 2075. I mean, the gold will reach is expected to touch these levels before the end of next year. Similarly, silver, we expect it to go to $25.4 to $26 an ounce. So overall, we are positive on precious metals. Thank you. That's all, sir. Over to you, Subramanian, sir.
Thank you very much, Akhil. I think your outlook is both positive and negative, if I may so in a lighter vein. Positive because gold prices are going to be up because whatever investments have been made in gold will be still valuable. The negative is that we can't buy more, and you know what happens when we are not going to buy more gold at home. Thank you very much, Akhil. Now,
thank you, everyone.
It's time for the question and answer sessions. We request the viewers to come in with their questions. Now, I would pose this question to Mr. Somasundram. Sir, we have been talking about this assaying. So, how do you see this assaying helping the gold consumers as well as the sector? And how far has the compliance been?
See, the hallmarking has been made mandatory, clearly. And initially, obviously, some councils, some members, influential members did have a lot of reservations about it. But as you know, Mr. Subramani, this hallmarking is not new. We started hallmarking in 2000. I mean, China started it much later and then got a mandatory hallmarking done. To say that I will be a great exporter, all right, but in my domestic market, I will have a differential standard, is never going to, help your brand. If you remember, olden days, this is what used to happen. Export rejects were much more valuable than the local production. That's not the case with many products now. We get the best of whatever we get anywhere in the world in India today. So while we have a good craftsmanship, I think not having a mandatory hallmarking always kept this market in all global discussions as something which doesn't care about purity, doesn't care about standards. Okay. So the mandatory hallmarking now that has been introduced with 256 districts, it will move on and it will cover 256 districts covers a bulk of what we are doing. Clearly, they raised the issues. That has now settled down. So I don't think there is any problem with the hallmarking per se. The numbers have just gone through the roof. There is another aspect to it, which is the HUID, which is the unique identification, where there are some reservations, because I think the conversations have just got twisted. Instead of saying that this is a consumer benefit, like if I put the HUID and I can find out whether it is genuine or not, that was the whole purpose. That's got confused with financial tracking of purchases. Now, financial tracking can be done in many ways. So that is still at, and also there were some teething problems in the infrastructure. They're getting sorted out. My own feeling, Subramaniam, is this will definitely pick up. This is absolutely a leading initiative. No other country has done this HUID. Technology always finally wins. There is no questions about that. Yeah. we all know what happened when computers were introduced. Now everybody is, wanting computers. They don't want computers. They want, flat screens. If there is a strike today, they'll say because we need flat screens, not the other ones. So technology always wins. This is a very, very sound technology. This is the way to go for the entire gold industry, not just for India. But at what point of time this is we are able to convince the trade to adopt it with all support is to be seen. I guess 2022 this will be one of the milestone events.
Can you? I'll add one more question from my colleague Suresh Iyengar from Mumbai. He wants to know whether the jewelers have settled the issue on the HAUD.
Yes, well, when you say jewelers have, there is always a section which is still not convinced. But that is what I'm saying. If you see, there was an article by the ex-Reserve Bank governor in recent times about, the farm laws. What he said, how to, sell any reform, which is for the greater good. It always takes time. So HUID, I don't think it has full support of the industry. Hallmarking, it has full support. But HUID will eventually, because it is a very, very high-end technology, good technology to have, it will eventually win. At the moment, I would split it between two. Mandatory hallmarking, yes, full support. HUID, not so great.
Thank you very much, sir. I would post this question from Mr. Somnath Nag, a valuable reader of BusinessLine, to Mr. Davi. He wants to know that gold and silver prices increase with inflation. How will gold react with dollar index, and what is the average value ratio of gold silver during the last 5 years? Now he wants to know the moving average. Mr. Davi.
I think Pinakin is not there.
Okay. Sir, would you want to answer this?
No, I would avoid any of these discussions on price. I don't mind taking the other one.
Yeah.
There is Suresh from BusinessLine. When US interest rate goes up, gold prices fall. And even taking into rupee dollar movement, gold prices is expected to fall. Historically, when gold prices fall, demand dips. Given this, how do you expect a demand bounce back? Now, first of all, given what Akhil has said, of course, we don't forecast. Given what Akhil has said, it is going to probably be on the upper side. But even taking the question that if gold prices soften further, you see the point between 2014 and 2019, which Akhil presented, if you see, it was moving sideways and there was no basic momentum in the price. When in those times when you have movements down, etc., people still wait because they said, look, nothing is happening in gold price. 6 months back, I saw it at 31,000. Now it is 30,800. It is coming to 30,400. Let me wait. Okay, because then the impression of a consumer generally is that there is nothing, there is no momentum in price. Right now, we have seen enormous momentum. And, we can call it volatility, but enormous momentum. And people, it has increased from 32,000 to 55,000. It's a 55-60% jump. Nobody's income has gone up that way. So when there is a 1,000 rupee drop or a 2,000 rupee drop, they will still see whether there is going to be another 1,000 rupee drop, but they will come back to buy in a big way. This softness is different from the softness you see when there is a lack of momentum in price. So at the end of the day, nobody can predict exactly what the consumers are going to do. But given what has happened in the last 2 years, very low purchases, as I told you, even the last 5 years, we have seen the average demand come down. Average demand has actually come down by 150 tons because of various transparency measures. Now, everybody is adopting it. The organized players are adopting it better. So when you start now, the market reforms itself, you will see a softness in price adds to the demand.
Thank you, sir. Akhil, you had given us an outlook on how prices will be next year, but there is Mr. Viresh Hiremat who wants to know what will be the price range for gold and silver, if you want to add some more.
I would say $1,680 is a strong base. So whenever you say that, whenever you see that price, we can continue to add. Even if there is a dip below that, I see bit not going below $15.50. So anywhere you see between 1550 or 1680, you can keep on buying. And as a long-term investor, you can easily average out, even if gold stays in a consolidation for a long time. So long-term investors can keep on buying, and as a thumb rule, it's always good to have say 10% of your overall portfolio in gold. So it's a buy. It's a buy.
And a silver.
Silver, similarly, it is around $21, and I don't see any further depreciation from here. Maybe we can see 2, 3, 4%, but not below that. So going forward, if there is a dip, it is a chance to buy.
Mr. Somasundaram, I have this question to you. See, we have been talking about transparency in gold, but we also see there is a rise in smuggling, or smuggling hasn't really, declined to the level that what one could expect. Now, your views on that, and probably how the government can, act on this, or how to really, run these guys out of business. Because what has happened is in Kerala and all, we are hearing stories about, hawala and these being used for anti-national activities and other things.
Yes, it is always one thing which stains the industry's image all over. Although it's small, it was not small some time ago. You had a 16% differential. The total duty was 16. Today, if you take the total duty on gold, landed duty on gold is 14.19%. Although it was cut by 5%, because I agree, infrastructure, it went up to, the cut was only 2.5%. And you add GST to it, it is 14.19%. Now, that's a very significant incentive for the gray market. So, and we have land borders, and we have a large retail, consumers, who carry gold between countries. So this is not a problem you can solve unless you bring an iron hand. And if you bring an iron hand, it's going to cause other kind of problems. Okay. So the important thing is, which is where all these reform measures come in. Let's look at what are the key issues, key windows that are open for the gray market. So that's why I said the exchange and all that stuff, they are going to change their own in bullion trade, because then people can really sell it very fast. They can get the price on the day, no counterparty risk. Now, you can't put a value to all that. As they become important and as the exchanges do it, you will reduce the gray market. But more important is 95% or over 90%, it has come in our research, of all gold is purchased in cash, even those which are with bills and things like that. Now, that is again a big window. Therefore, when the entire industry is dealing in cash, it becomes easier to also leak in the gray market products. Correct. So it has got to be attended to. At the same time, you can't simply say they must pay 1.2%, 1.3% merchant discount rates to buy gold. Nobody is going to pay that much money. We've got to find a solution to this cash thing. The second very important thing, which I alluded to when I spoke about exchanges, clean up the recycling market. We got to clean up the recycling market, give more incentives for recycling. We only now talk about gold monetization scheme, but you have to look at an overall recycling. Today, if I take the gold back, even if what I have purchased with an invoice, we don't get the GST back. Clearly, they are not helping. Yeah, it is the right thing to do when you look at it in a particular framework. But when you look at gold, because it has got practices over years, and all the practices were towards saying that, don't disclose this to anybody. I mean, that has been the fundamental principle. You have to give more incentives for the gold, for people to declare the gold, for people to recycle gold. So these two definitely are very important. If the duty is not cut, even if the duty is cut, I'm saying these two have to be attended to for long term, because duty can always go up. Tomorrow, if there is a 1,000-ton import, the government is not going to wait. They will raise the duty. So again, the duty is not going to come down sustainably unless you have a good recycling market, unless you do mining. unless we find other ways of adding value in gold. So I think we need to address these three things together: duty reduction, organized recycling, incentives for them, whether you call it under monetization or whatever it is, and address the cash payments. Give huge incentives for paying through non-cash when you buy gold.
Absolutely valid point, sir. Akhil, would you want to answer this from Sri Kumar, who's asking what makes gold bullish? Because they're saying generally views of bearish. And would you also add a couple of fundamental points that could make gold bullish?
From a technical point of view, as Somasundaram sir said, it has gained enough momentum since 2019, and it has not really subsided. And to substantiate the bullish view, I would say even the talks of the so-called interest rate hikes and tapering has not really affected the gold price much. So it has held on to the base very well. And from positioning of big players' point of view, we can refer to World Gold Council's data, which shows that speculators have started adding long position more in the last 2-3 months, and they are turning bullish. And in fact, the net long position in November was the highest in the past 1 year or so. So even if the prices staying at higher levels, speculators are already turning positive. And as Somasundaram sir told, when demand also is expected to go because people get used to this price. So I don't see any big drop in price from here. Of course, we can see 2-3% drop. There will be knee-jerk reactions when Fed start to raise the interest rates. But I don't see that changing the overall bull trend of gold.
If I may add here, Mr. Subramani, I may add to what Akhil said. See, we are in an extraordinary situation. I mean, everybody has spoken about, the economists have spoken about how the balance sheets of central banks have expanded. I mean, it is unprecedented levels. You can't take it like you were talking about it in 2000 or 2005, okay, an interest rate. In fact, if you recall, 2019, what happened? 2018, there were rate increases, right? 4 or 6 rate increases. Then 2019, they realized that it is not working. Therefore, suddenly, Fed came and said, now we are going for another QE. And that opened the thing about gold price. It just shot up from 1400 and then reached 1400 and touched 2000. Of course, it's softened since. This is again something we need to keep in mind. Now, while I don't forecast price, what I'm trying to say is, look at the global scenario. Yes, everybody expects because of inflation, rate increase will come through. But is there going to be a reversal of the QE? Is it actually, are they going to reduce the QE? Already the reduction has caused a little bit of a stress. Now, if halfway through, unless people get confidence that this is a journey now that is irreversible, gold bulls will be waiting. Because, the first card, second card, looking at the balance sheet, you got a long way to go before you are convincing the world that, yeah, now we are in a normal scenario. So the risk scenario on the currencies is very high. Therefore, it is not just one rate cut which is going to change our view on that. Yeah, immediately there will be some interaction, but we all know, and we have seen it just 3 years ago. So it is therefore important to see how it is sustainably done. Rate increase is going to come, clearly. I mean, they have even said 2, etc., etc. But is it going to be sustainable? Or is it going to lead to another, bout of QE? We don't know. So it is, therefore, gold people will not just, take everything at the immediate event and then say, oh, this is now an irreversible trend. So that's one thing. Second, what happens to stock markets? See, stock markets have run up very well, but very, very soon, very fast. Right? Now, therefore, the risk is very high. As Akhil said, you need to keep at least 10% of your portfolio in gold when you are taking risk. But given the overall risk scenario, and look at what central banks are doing, they're also buying gold, unprecedented levels. It is therefore important, probably it should go to 15% gold in any portfolio because you're taking a higher risk, even if you're a normal investor. So we have to therefore look at all these, and these theories will come in at play. Financial investors will have to probably give their clients the right advice, and gold will form a very, very important ingredient of that.
Thank you, sir. So we have two more questions for you from our viewers. One is from Bhavya. She wants to know that today's people concerns are about purity of gold. So will hallmark ensure this? Well,
Bhavya, you raised the right question.
Bhavya, sir.
Bhavya, that's what. Bhavya, you have raised the right question. Is it does it answer all the questions? I mean, if something is hallmarked, is it absolutely pure? That is what HUID was supposed to do. Like if you put the number, then BIS actually tells you whether it is genuine hallmark or not. Even today, what we hear again anecdotally, there are pockets where you do have fake hallmarking going on, etc. BIS is doing a great job weeding out all these people, etc. But you can imagine when something like this happens in a large country with diverse sizes of jewelers, this is bound to happen. Therefore, largely, yes, when it is hallmarked and you get it from a proper jeweler, invoice raised, GST paid, etc., I think you can now assume it is hallmark jewelry, because you can always take it, get it hallmarked again, and if there is a problem with the purity, you are entitled to a compensation. Therefore, this is I would say the scale has really gone up in the compliance. But is it 100%? I wouldn't say so.
And the other question is from Ranjan Sridhar. He's now going forward with your scrap market. So he's saying that in addition to scrap market, should we not also give thought to building a market for used jewelry like it is with used cars, so that people who buy jewelry can get a higher price than from the scrap?
Absolutely right. I mean, if you take Indian gold market, there are quite a few which remain I would say underdeveloped. Let me talk about the used jewelry. Today, most of the gold loan companies, when they auction it, I mean, it is sold as a used jewelry. But if you really see it, we don't look at that market as a great source of jewelry. I mean, in fact, the people who have pledged the gold don't get probably, if it is a real second-hand market, you would probably get more price, etc., etc. And second thing is, people with really big size temple jewelry kind of stuff, wedding jewelry, if there is a used market, maybe they could encash it without going through the monetization scheme. Absolutely right. It should be developed. But as I said, first thing is, you can only develop it when you have a few incentives like GST and things like that. India always responds to incentives. I mean, insurance market grew on the back of tax incentives. For various reasons, we still haven't delinked our thinking from anything on taxation. So, and even if it is too minuscule, I think some psychologists should read this and say what it is and advise the government. We definitely, some tax benefits, okay, always drives our behavior. So that must be looked into.
Thank you, sir. Before we wind up this discussion, there's one last question. I mean, I would ask Akhil to answer this. Sukumar and Ajish wants to know how to buy gold and silver in exchange. We can help him, fine.
Sorry, sir. How
to buy gold and silver in exchange? If we can help the Kumar and Ajish wants to
exchange that. I mean, we can buy futures, and we have options contract, and futures contract are physically deliverable. So through exchange, you have futures options contract.
First, they will have to open a KYC, and then demat
with a broker. Demat with a broker. Then I'll do all the KYC process.
But if you have if you have an account already with one of the big broking companies, and if you have an online, it's a straightforward thing. You already have an account, the KYC done. So I don't want to name the brokers, but I'm just saying all the big banks have the broking accounts. If you already have it, I think operating in the commodities market is a very simple process, because now it's all universal exchange also. So it should not be difficult at all. If you've already dealt in the market, buying gold in the exchange is a piece of cake.
Thank you, sir. We have had some very valuable discussion, very enlightening views from your side, some valid points raised. I hope the government also listens to some of those valid points that you have made during the discussion, as also Mr. Dave and Akhil. Thank you all for this wonderful session. We are now moving over to the second session, which is the outlook on base metals. Base metals have seen impressive gains on the back of production setbacks due to COVID last year. Supply was also pushed up prices, while China's power crisis also had a part to play, though minuscule, in October. This year, copper has gained over 20%, nickel over 15%, lead 17.5%, aluminium 35%, tin almost doubled, zinc has gained by a quarter. The LME index has gained almost 25% this year, and the coming year promises to be a good one for aluminium and zinc. The greening of the economy also holds promise for metals such as copper in the long term, as also other metals. These are just some of the views, but it's time to turn to the panelists to hear the views. We now have a special address from Mr. Mayur Karmakar, Managing Director, International Copper Association. Mr. Karmakar is the Sustainable Energy Team Leader of Copper Alliance, the global network, and he is also Managing Director of the International Copper Association, India. He is responsible for the Alliance's sustainable energy and electrical safety programs. Over the last 2 decades, he has promoted energy efficiency, the use of renewable energy sources, and the generation of energy. At ICA, Karmakar has led projects such as development of Enabling Technology Center for Copper Rotomotors in India, and the government solar water heater market transformation. And he also experiences in Egypt, UAE, and India. I now welcome Mr. Karmakar to present his views. Welcome, sir. Sir, you will have to unmute yourself.
Am I audible now?
Yeah, perfect, sir. Thank you.
Thank you. Good afternoon, everybody. And thanks, Subramani and in the BusinessLine for inviting me. Let me first tell you what is International Copper Association. International Copper Association is a 35-member body, which largely represents the global mining as well as the smelting and the fabrication industry. We largely work on the sustainable market development as well as the upstream sustainability program activities, largely addressing the current issues which are happening at the the copper production end. In India, we have been working since 1998, and we are largely engaged in India for the market development program. Now, when we say India, we need to know a bit about few takeaway we should have in mind when we talk about India. India is the 5th largest economy in the world, $2.7 trillion in 2020. We are the 2nd largest in population, so demographic wise we have very strong 1.4 billion population. We are the 6th largest manufacturing output, which is almost like $400 billion. And there is a opportunity for us to improve on that rating. We are the 12th largest exporter, which is not really very significant, but I'm sure with the industrialization policies and the export focus largely coming in will make the difference there. And we have the 4th largest forex reserves. Now, being in ICA, so being in ICA, we are governed by the antitrust guidelines. So in my presentation, I won't be able to talk anything related to price, any competitive information related to the countries, as well as for the mining industry, and if new products which are being developed, and we are compared by these antitrust guidelines. Now, when we look at the India, the major important thing we need to remember that we will refer end-use copper demand here and not consumption, because copper is not consumed. It's recycled for the infinite number of times. And therefore, I think the consumption word for copper, which is generally used in all the commodities, is not technically correct. So we'll talk it as the end-use demand finally. Then we have, the copper's recycling property, and also in the recycling process, the burning loss and the oxidation loss, etc., are relatively low. So as a result of that, copper, which was mined years ago, still remain in some form in different usage. So if we see last 3 years, how the copper market has changed, copper market has grown at the rate, somewhere nearer to the GDP. The nexus between the GDP growth, or what we call it as a correlation between the GDP growth and the copper growth in India, is not 1-to-1, which was there in case of China's peak growth time. And we are still, having that correlation is somewhere 1 to 0.6 or 0.7. So every 1% of GDP increase adds the commodity growth of 0.6 to 0.7. Now, these numbers you have to look at under, at least 3 or 5 years average basis, and you just can't do it on year-to-year basis because of the some abnormalities happening around, including the COVID. So the macroeconomic driver for the copper and copper alloy will drive the copper demand largely in the country. Now, when you look at the COVID impact overall, there are few learnings out of the COVID impact and the data what we have collected. Although the COVID impact has pulled down the GDP by 7%, but overall copper demand has degrown by 17 or 18%. And the largest degrowth happened there, as we saw there in the infrastructure sector overall. And also, if we have seen that is happening there in the electricity sector and other industrial sector. But the relative deterioration of growth in the building sector and the consumer sector was very low. In fact, the aircon, we saw the copper usage in aircon only degrown by 8%, whereas the copper usage in electric motors, which is one of the end-use application, we saw down by 31%, and product like transformers down by 40%. This was the particular year where we saw the decoupling to the GDP happen. There has been a lot of discussion about the GDP number itself, but if we have any number coming up, we saw this decoupling happen, and that decoupling has happened because particularly for this year, we saw a big shift in terms of even the demand pattern compared to the previous year. So the learning out of the COVID, the few takeaways that even though the GDP degrowth was 7%, the copper market has dropped down more than the normal. The copper demand was almost 1 million ton in 2021, which was 1.3 million in the previous year, 1.2 million the previous year, etc. So on the supply side, there was the disruption happened because of the entire logistic problem and the COVID. But after the COVID lockdown, which was in Q1, in a subsequent quarter, the integrated plants could ramp up the production, but still could not match to the previous year's number. And then on a sectorial impact, as I mentioned, you saw the degrowth happening lower in the residential sector. Everybody was working from home perhaps, and then also the white goods sales are not impacted badly as compared to the infrastructure related products, which are where the copper is used. So now going forward, I'm going to put you something which we have worked with EY. And this is what we call it as the ACE curve of the commodity or the metals. If you see the GDP curve, which can be segmented in stage 1, stage 2, and stage 3 of the GDP, And we strongly believe we are on the verge of, or the threshold of moving from stage 1 to stage 2 for all the commodity. You see the commodity usage, what we have on the per capita is the lowest in the world for all metals. And this would change largely with having a larger disposable income, having higher GDP per capita, and the infrastructure investment, so many other things which are lined up already. So we will be moving towards the stage 2 of the economy, where we see that the correlation between the GDP and the commodity usage, including copper, will be different than the previous. In some years, you will find it will go to 1:1, or sometimes even it's more than even 1. And the stage 3 is a particular time where it's almost a plateau of the demand for all the commodity or the negative. So, the increase in the initial stage economic growth we have seen, where the growth was only 4-5%, somewhere 3% for copper, which will be directly, that ratio, the correlation between the GDP to the, metal growth will be higher. So you can see that how the initial growth in China before year 2000, the growth pattern was more or less similar like what we had for all commodities, including cement. But that relationship has changed drastically when they moved away from the influx point from stage 1 to stage 2 of the economic growth. Then in maturity stage, you may find even the declines happening on a per capita usage of the metal, which is seen there in Europe, which is seen there in US, and which is seen in Japan also. There are multiple reasons to it, as there are a few reasons which are also linked to the supply side, where the manufacturing also moved away from those economy and will get into economies where there's the demand there. So I strongly say that and believe that we are at the emerging economy. We are young compared to the metal usage, and this is what even the aluminum industry and the steel industries, very much saying the similar thing. And we will grow on a metal usage at the faster pace from year forward. So what are the drivers largely on the copper particularly? That is the GDP, estimate growth. We together with EVA believe that 5.2 trillion, although there will be some, ambitious goals which are created, it will take a little longer, perhaps 2030, which is a bit pessimistic, but from this study was done for the global mining industry, so we wanted to work on a bit pessimistic scenario and not very aggressive or optimistic scenario. So we projected this growth getting to 5.2 trillion by 2030. We see the urbanization rate going to increase. You will have more houses, more urban infrastructure coming in. There will be rapid disposable income coming with, GDP growth per capita, which will create a lot of buying power, particularly the product like aircon, where your penetration is just like 4% compared to 50 or 60% in some of the Asian developing countries. So there's a huge divide between the white good distribution within a country, which is linked with the economic divide, and the growth in the per capita income will address these, gaps definitely. Then the, demographic shift is something which is even more visible now, that the dependency ratio is going to reduce from 70 to 65%. That means more people will be, engaged with the economic activity than what are there today. Then industrialization policies, the industrialization policies, there are multiple policies. Even during COVID time, they have been announced. So industrialization policy will a continuous process, and this will promote the investments in a country and will increase the manufacturing activity. Unlike, the other commodities, particularly some ferrous and some non-ferrous metal are largely linked with the, their growth depends on industrialization overall. For example, for making 1 ton of cement, you will have the machinery which will require copper, which will require iron itself, which will require aluminum. So industrialization is far more important for the commodity growth. Then the decarbonization, which we heard recently, in the previous session as well, that the certain new technologies such as renewable electric vehicle are going to add more copper. In fact, the densities, if you just for information, if you are adding 1 megawatt of the solar plant, you are having 3 tons of copper demand created with that. If you are adding 1 electrical vehicle, you can have anywhere between 83 kilos to 45 kilos of copper in just that vehicle. Forget about the charging infrastructure required for that. The charging infrastructure is something which is additional opportunity, which is linked with the infrastructure. On an average, today the world's best average for in the rollout of the electric vehicle, for every car there are at least 6 charging stations linked with that. So those number of charging stations are going to create additional demand for copper. And then the rapid increase of overall electrification, which is like swapping from the fuel traditional petrochemical or petroleum products to the electrification itself, is going to have a new demand drivers going forward. So these stronger policies definitely are in pipeline. I've just compiled a few policies which are there, which are supporting the drivers. And the number of policies which are coming these days are far more, I would say, fundamental in terms of changing the overall economic or economic growth, propel the economic growth totally. So the important one which was announced recently was the net zero objective by 2070, but net zero by 2070 means a lot of activities and investments will be there by 2030. And besides that, related drivers, and then the policy, creating the proper, I would say, infrastructure as well as the opportunity for the growth overall, which is linked with the privatization and the infrastructure development, which will support the copper growth going forward. So as a demand scenario, what we estimate that in this decade, we will see the average growth going somewhere around 8 to 9%. And by 2030, the demand for the copper will be over 2 million or 2.2 million, which is highest growth rate what we have seen in the compared to the past, which is the highest one. And the largest market growth we see in the building construction market largely. There are multiple drivers for having these growth. One of them is safety, but besides that, other important drivers are the load density happening, the demand for more electricity per house itself, and then we have the another outstanding growth market will be the transportation, and transportation is largely because of the electrification of the transport sector, largely the two-wheelers and three-wheelers. So the 2.2 million ton copper demand by 2030, with that number will be third largest, definitely the third largest as of now, third largest copper market in the world. Thanks.
Thank you very much, Mr. Karmaka, for those very enlightening views. I now invite Mr. Sandeep Daga of Rexus Consulting to make his presentation on the fundamentals for the base metal. Welcome, Mr. Daga.
Everyone, good afternoon. Am I audible? Mr. Subramani, am I audible? Is my screen shared?
Yeah, audible.
And is my screen shared now?
Yeah, perfect.
All right, thank you very much. Firstly, thank you very much for having me on the forum, and thank you for the invite. I want to take you through just a few select slides on base metals. But before we talk about 2022, I want to talk to you about 2019. 2019 was a year when China was engaged in a trade war with US. There were retaliatory policies on each other. China was slowing down, and the rest of Southeast Asia was also slowing down. It was also the year when the automotive sales were slowing down all over the world. In fact, the global economy was in a slow lane. And the reason was very simple. It was because 2009 onwards, the multi-years of expansion was looking exhausted. The expansion, which was supported by stimulus from China and Europe and US multiple times, that was looking tired. And then in the first quarter of 2020 came COVID. COVID was a health crisis. Unlike 2008, it was not a financial market crisis. But what it brought was a complete stop on the economic activities. All of us got scared. The government got scared. The central banks got scared. And because of which, they came up with the policies, the stimulus, which had never happened in the history of humankind. And this brought up demand. The demand started to recover from March, and by December 2020, it looked like an economy which was almost in ICU was running in an Olympic race. It was complete metamorphosis. Our expectation entirely changed. And this was driven by China, US, Europe, and also India. All of us recovered. So 2020 was an year of a sudden stop and a sudden start. And then came 2021. 2021 became very different from 2020 as far as the base metals are concerned. So let me take you through what happened in 2021, which is this year, and how it is shaping up the price outlook for the next year. So the story of 2021 is that the demand growth slowed as the year progressed. The first thing that China did was that after it stabilized the economy in 2020, it started to slow down the release of stimulus money into the economy. The credit growth started to contract. And we have historically seen when China slows down the supply of money in the economy, the manufacturing sector starts to suffer, the construction starts to suffer. And that started to happen in China. So Chinese demand for metal started to come down because government was engineering the slowdown. Yet, the demand for the Chinese goods from the Western economies was very, very strong. This was because the Western economy had the stimulus and they were just unlocking from February, March of 2021. So they needed goods and China was ready to export those out. So Chinese export of durable goods, which consumes a lot of base metals, started to jump. As you can see in the chart, in March, April, May, it went to a new high. But then over the period, as those demand was satiated, the production and the exports from China started to fall back to the levels, to the normal levels of previous years. And as the year progressed further, we saw another problem in China, which was the property market crisis. So property market was in a slow down phase already all through this year because the credit supply was tightening. But by September 2021, Evergrande, which is the largest real estate developer in the country, they came under pressure of default. And then it spiraled down to many other companies like Kaisa Group or Modern Land and Shiba Group and not many of them. So when the credit supply started to slow and the construction activity started to slow, the investment activities into real estate sector started to slow, we saw that the new construction, which consumes a lot of commodities, started to slow as well. So as you can see in the chart, Except if you exclude the January and February 2020 because of COVID, the construction-related slowdown in China is worse than 2015. It was not only related to construction slowdown in China, but the overall infrastructure development in China started to slow. So as you can see in this right-hand side chart, the infrastructure spending by the government in provinces have now come back to the pre-pandemic levels. So overall, Chinese spending, their buying of commodities was slowing all through 2021. And as the year progressed, new chapters of slowdown were added, one after another. But yet, prices rose. So why did the prices rise? It was not a demand-driven story. It was a supply-driven story. So there was a supply crunch. Why? There were many reasons for it. Reason number one was that the sea congestion became very, very high because there was a strong sudden demand of goods from the Western economies, and the ships were engaged for transporting those goods from the eastern part of the world to the western part of the world. And because of which, the availability coming down slowed down the movement. And because of which, nearly 1 to 2 months of metal inventories got accumulated either at sea or at port. Now just imagine that the global inventories are around 1 to 2 months. And when those inventories starts to accumulate somewhere else, the congestion would start to slow down the whole supply chain. But it didn't stop there. Another thing that happened is that the output of metals in China started to fall. Now, typically, the Chinese output should have been rising now because the demand is good, the price is good, and therefore the supply should be rising. But there was an energy crisis in China. And the coal shortage became so big that there was a rationing of electricity supply to the companies there. And because of which, the output of metals started to fall and went into contraction as the year progressed. And this was the major reason why the inventories of China started to deplete. But it did not, the supply crunch did not end there. There was a natural gas shortage in Europe. And because of which, the two large smelters of zinc, the Star and Glencore, these two producers had to close down the capacities in Europe. And this added to the crisis. So overall, we did not have a strong demand recovery. We had a moderate demand recovery, but the supply side shortage became too big to handle. And because of which, the Shanghai inventory started to fall. As you can see, the Shanghai inventories fell back to the low seen in 2016-17. But it did not stop there. The LME inventories fell down further. Now imagine that the consumers in US and Europe are not able to get the imported metals in time. They will have to turn to the LME warehouses to the nearby locations and draw the inventories from them. This has started giving a feeling that there is a shortage of metal, there's an acute shortage of metal to the Western investors. And they were right. There was a regional shortage. But was there a global shortage? Not really. The metal was stuck in different places. Now let's look ahead. So in that background of 2021, how does it look like? Now, 2020 was an year of demand recovery. 2021 was a year of supply crunch. 2022, one would expect that we are going back to normal. Now, what does normal means? For me, the normal is that we go back to 2018-19 levels and we move above the COVID-related disruptions. Now, this normal has started happening already. So as you can see, the industrial growth all over the world is moderating. Irrespective of what the PMI data could tell you, the YOY growth of industries all over the world has come down to single digit. including for India. The IP growth of Germany and Japan, which are very large industrial economies, have gone into contraction already. Now, this is what it means is that the new pipeline of manufactured goods or orders thereof is slowing. And why is that slowing? Because the fiscal stimulus is fading globally. People are switching from goods to more services. And also, the manufacturers are finding it difficult because the margins are under pressure. The consumer prices are not rising as fast as the input prices of commodities. The margins are under pressure. So, in my opinion, this industrial normalization, I wouldn't say a slowdown, a normalization is set to continue at least for the next 2 quarters. And then let's weigh in the US inflation. US inflation is 6.8%. Now, 6.8% inflation even for India is big. For a country like US, where normal growth is 2 to 3%, 6.8% is huge, is very large, is unbearable. And this is the largest since 1980s. And this is creating a big headache. Now, why a big headache? Simple reason is that in US, a large number of unemployed pool of people which got created after COVID have been employed back. So the labor pool is shrinking very quickly. Over the next 3 to 6 months, US may go back to full employment. And typically when they go to full employment, the interest rate peaks, the inflation spurts. This time around, we have not seen that because the US central bank had been very, very slow and cautious in not to overdo so that the economy slow down. Now, in my opinion, the inflation in US is going to further speed up or remain very high in the coming 2 quarters. And because of which, the Fed rate hike could speed up. Or there could be reasons for people to start getting worried that the demand slowdown has become imminent in the Western world. Now, this for the metals would mean that the stronger dollar would mean lower metal prices typically, and this would also slow down the demand all over the world. Now, the most important aspect for metals at the moment is that whether Chinese output will go back to the normal levels. Now, we have seen historically when the demand goes up, the deficit comes in, the inventory comes down, the Chinese output starts to recover and they replenish the inventories over years. This time around, this got delayed because of the energy crisis. China was doing it in the first quarter of this year, but then came the energy crisis slowly and gradually unfolding in 20 provinces of the country. Now, because of which the output growth has not really come to a typical Chinese recovery. The big question of 22 is whether we would see this recovery. I would expect that for the simple reason that the energy crisis in the country is nearly ending. The coal output is above 12 million tons per day, which is a record high. The power is coming back to the industry slowly and gradually, yet government would like to divert more power to the industry only after the winter period is over, which is, let's say, end January or so. That means the demand, the supply is going to recover from the mid of first quarter of next year. The domestic inventories of China is low. At the same time, the government also wants lower prices. So this is another reason why government would allow the industry to produce as much as they want. But China this time around would not overproduce, unlike last year. And that would mean that in the second half of the next year, China would start to curtail the supply growth. So let's have a look at the fundamental outlook for base metals. My thought is that the high prices of metals, which has remained for almost last 6 months or so, have been killing demand in Asia. I am not speaking about the Western world where things are still supported by the government stimulus, but in Asia, in China, in India, in the Southeast Asia, the high prices are becoming big worry for the consumers. They're deferring the buying, they're slowing down their purchases, or they're purchasing lesser. And this is quite clearly seen across metals. Second thing is that the forecast of most of the analysts around the world is that next year we could have a surplus for most of the base metals. And it looks very natural because, as we are saying, the demand is going to moderate further while the supplies is going to gradually recover, especially in China. And therefore, the exchange inventories are going to gradually replenish. Now, another factor is that euro dollar may strengthen further because if inflation really goes up and Fed starts to tighten its belt, it's possible that dollar may strengthen maybe in the first half of the next year. There are some rumors of Chinese stimulus coming back again because China has slowed down too much this year and the property market is in very, very bad shape. There could be stimulus, but China has clearly stated that all the stimulus would be very moderate, very sectoral to a particular direction and not a wholesome, unlike what they did in 2009 or in 2020. So broadly, my thinking is that we are heading to a fundamental catching up with expectations. And that would mean that the heady prices are going to gradually moderate from here. We could see a serious correction over the next 6 months or so that the prices become more acceptable to the consumers and kind of fair equilibrium is reached between demand and supply. That's what I have on the presentation. Back to you, Mr. Subramanian.
Thank you, Mr. Daga. It's time for technical analysis, and we have our Chief Research Analyst, Gurumurthy K, to make his presentation on the base metals. Over to Gurumurthy.
Yeah, good afternoon, everyone. I hope I'm audible.
Yeah.
Yeah.
Yes,
so I will just not take much of the time because, as rightly said in the beginning, it's Friday and it's almost, we are nearing the lunchtime. So I will take a quick look at what the chart says for the base metals. I will be covering 4 base metals here: aluminium, copper, zinc, and lead. As Sandeep had said earlier, the fundamentals are looking weak, like he said that prices can come down. The same is what is reflecting on the charts also. So this is the Bloomberg base metal index. The chart is the monthly chart. So this clearly shows that the index is peaking, has already peaked around 300 in October, and it is consolidating there only. So there are fair chances that we could see a sharp fall in the index. So the pink color line which I've drawn is the possible path of move that we are expecting, that we can expect going forward in 2022. So right now we have a support on the chart at 260, which can produce a bounce to 270 or 275 in probably in the first quarter of 2022. And then from there, we can expect a crash in the index to 230 levels towards the second half of 2022. So from there, there is a possibility of a recovery towards 250 or 255, and that will be followed by a much deeper crash to 200 levels. The one thing I would want to highlight here is that the crash to 200 might or might not happen in 2022 itself. But if the situation is going to continue, if the charts are going to work well, then that can happen in 2023. So the probable path of move for the Bloomberg base metal index will be that the upside we can expect it to be capped at 270 to 280 right now, and we will get a fall to 230, followed by a rise to 250, 260, and then again a fall to 200. The same path of move has been visible or can be seen in the other base metals also. I will now move on to aluminium. So aluminum, sorry. So aluminum has peaked at around 3,200 and it has been coming down. Right now, it has a support in the 2550, 2450 region, from where we can get a bounce to 2700 or 2800 max. But a rise past 2800, beyond 2800 is looking unlikely now. And from there, we will get a fall to 2300 first, and then a small correction to 2450, 2500, and that will be followed by a deeper correction to 20,000, 2000 levels by the end of 2022, or maybe as we go into 2023. So all these prices are LME prices, and the prices I have taken here is the 3-month rolling forward contract, which is widely used as a benchmark in the industry. So the view here again is bearish. Right now we can get a bounce from 2500 or 2450 towards 2700, and then we'll get a sharp fall to 2000, which will be in between the fall to 2000. There can be a small corrective rise from 2300 to 2500. So the next is copper. Copper, if you see, it has been broadly sideways since this year, so since the beginning of this year. The broad range that we have seen is between 9,000 or 8,700 to 10,500. This sideways range can continue for some more time. But going forward, maybe from the second quarter of next year, we can expect this range to break on the downside, and copper price can fall to 7,500 first. Then from 7,500, we can get a bounce to 8,500, and then again another leg of fall to which can be deeper to as much as 6,500 or 6,000. So as Sandeep rightly said, that there can be a slowdown in growth because of higher inflation, and the Fed increasing the rates much faster than what the market is expecting. The copper chart is also reflecting the same. Like copper is, as everyone knows, copper is a well-known gauge for the global economic growth. Since we see the copper prices coming down, it could mean that the global slowdown is on the way, and that could impact go in line with what Sandeep had said on the global growth slowdown. Next, we come to zinc. Zinc, compared to the other base metals, zinc seems to be relatively on a better place. We are not expecting, the chart does not show really a sharp path for a fall. It looks like there is still some more upside left for the zinc to move. So from here, we can expect zinc to move to 3,600 at least. The chances of the prices moving up to 3,800 or 3,900 will have to be assessed. So from there, maybe we can get a fall to 2,600 going forward into 2022. So compared to the other metals, as I discussed till now, like copper and aluminum, zinc is not looking as bearish as the other two metals were discussed earlier. So when it comes to zinc, I think the chart says that there is still some more upside left to be done, and then maybe we will get a fall to either from 3,600 itself or from 3,800 or 3,900. From there, we can get a fall to 2,600. The last one will be lead. Lead seems to be like it has not gone anywhere. If you look at the charts from 2010 onwards, we are having a very broad range of 1,600 to say 2,600 or 2,800. So over the last 10 years, the prices have been moving up and down within this broad sideways only. So this sideways range can continue going forward also, unless we get a breakout on either side. We are not looking for the price band to widen anywhere beyond this. So within this range, lead also looks relatively a little positive in the near term to go up to 2600. At least 2600 can be seen there. We'll have to see how things are turning about for the prices, whether it can go still further up to 2700 and 2800. But clearly at 2600 and 2700, lead will definitely be a sell. So whoever are there in business of lead should watch this out. If they are exporters, then they will have to look to sell at 2600 to 2700. Whereas when it comes to importers, they will can wait to buy at lower levels. So from 2600 to 2800, anywhere between there, preferably from 2600 itself, we can get a fall to 2000 first, and then a slight bounce back from 2000 to 2300 or 2400, and then again we will get a fresh fall from there to the lower end of the range, which is 1600. So as I said, for the other commodities, the fall to 1600 might happen in 2022 itself, or based on how the things turn out, it can happen in 2023. So these are the four things that I have discussed. So to conclude, 2022 is not looking as rosy as 2021. We are looking for a price correction as seen from the charts earlier, especially the Bloomberg dollar index has peaked. Sorry, the Bloomberg commodity index has peaked. So the cycle has to turn around from here. And within this base metals, one thing to watch will be copper, which is showing that a global growth slowdown is on the way. So overall, 2022 is going to be a bearish year for base metals, and we can expect the prices to come down in 2022. There is not much upside left, though there can be a rise initially in the first quarter of 2022. The upside will be limited, and after a small rise, all the base metal prices are likely to crash from the second quarter or in the later part of 2022. Thank you so much.
Thank you, Mr. Gurumurthy. Something which I thought I should ask you. You answered it towards the end on the first quarter, because I thought maybe I should ask you about the first quarter, but you've already put up a nice caveat saying that the first quarter thing could be a little up before they're heading down. Now it's time for the question and answer session. We would request the viewers to kindly post your questions here with your name and other things. Now, I would want to put this question to Mr. Karmakar. Sir, the greening of the economy, what sort of impact it will have on copper in particular, because people are a bit bullish about copper, especially on the greening of the economy.
Yeah, the greening of the economy will have various technology interventions and the measures going forward. There has been the projections or the studies done on the global basis, particularly by IEA, and IMF also has come out with the similar studies, which includes, in fact, for all the commodities, but particularly the copper in India. If we want to have reach to 450,000 megawatt or 450 gigawatt of renewable, having the the target of at least 10 million two-wheelers or few million cars, electric vehicles on the road, in order to solve the decarbonization problem or decarbonization objective, we are going to address the variability of generation in electricity demand. So we are waiting for the battery technology to come in. Companies like Reliance Energy Ventures have already started investing into all those green technologies there. So going forward, we see that particularly in the transportation sector, the electric vehicle will have the larger demand. And in my slide, I put that on a long term, the rate of growth for the transportation sector, copper usage in the transportation sector will be in a double digit. The next sector is, of course, the energy sector, which is the renewable energy sector. Again, with the objective of 450 gigawatts, even if we have average 10 plus gigawatt per year of solar, is going to have minimum 30,000 tons additional copper. So these numbers are, are very simple, very density based. And as you get the numbers higher, you can easily project what could be the demand for the specific commodity. The global numbers are out. There are no specific India numbers has been worked out yet, only because we have those numbers, which is we work together with EY, but it has multiple assumptions, and particularly in India, all the things which doesn't go as per the assumption. We have 2 years of great, then again we reset our some of the trends, and then when you start building up again. So on a long term, our the projecting something for that particular year is difficult in India, but on long term, yes, those numbers are available. And as I've shown in my last slide, you can see the different numbers adding up to which is here. You can see here the sector like transport sector, the building construction sector overall, which will be 500,000 ton. Then
you're not able to see the screen.
Oh, sorry.
Oh.
Yeah, can you see now?
Yeah.
Okay.
Yeah.
So if you see the transport sector overall going from 74,000 to 277,000 ton, which is the greening of the transport sector largely. Then you will see the growth in the infrastructure from 233 to 428, which is largely with the power infrastructure, and then the building construction, which is based on the India's population, the rising income, and need for having more, houses, commercial building, and overall infrastructure. So those remains as a fundamental driver for the future growth, out of which the greening part will add into infrastructure, which is energy infrastructure, and also the transport sector largely.
Thank you, sir. Now I would ask Mr. Dadav, on this, there's a talk of monetary policy tightening by most of the developed economies. And then, how far is this going to have an impact on the construction sector in particular, and also looking in the background, whatever has happened to Evergrande in China? You'll have to unmute. Yeah.
So, the interest rate policies of different economies are going in different directions. And that's not a good thing. So if you look at China, which started to slow this year, they want the interest rate to be cut. They want the reserve, they already cut reserve rate twice this year. They want to have enough liquidity in the economy. On the other hand, US is just the other extreme. They are in a hurry to raise interest rate now because inflation is becoming unbearable. So there can be two diverse policies. So if China, but there's one thing, if the US Fed reduces the money supply or tightens the monetary policy, the rest of the world cannot go against that for a long period. They'll have to follow that path. Otherwise, this will have a large bearing on the currencies, which nobody wants. So from that point of view, I think interest rate all over the world have bottomed. It cannot go lower from here. But the pace of rise would depend on the inflation, on the recovery in respective economies. And that would have a bearing on the construction in different economies. Now we talk about three different economies: China, India, and US. Now in US, the demand for houses was very, very strong. The housing prices have gone up by 20%, the highest pace in many, many decades. And therefore, there's a need for new construction. Now, what we are seeing in US is that the demand for houses have started to taper off because people got money from the government and they bought houses, or they made gains in the stock market and they bought houses. That demand has started to taper. At the same time, the construction has started to pick up. And I don't think in 2022, this trend is going to change. I think there will be more construction because there's a healthy margin available in the housing market with 20% lift in prices in the US. So irrespective of the prices going up, I think construction industry in US in 2022 would still do good. But when it comes to China, we should look at the big picture. The big picture is that the Chinese economy had a 20 years boom in the construction market. People bought houses for investing. People, and they had multiple houses in different cities. They created coast cities. We heard all these stories in the last few years. Chinese government does not want any further speculation in housing because they know that when the economy starts to slow, this real estate bubble becomes too big to handle. And we have seen the same in Japan in 1980 when the economy started to slow. There was a bust, and the Japanese land prices have not yet come to the original level. The similar thing we saw in the tiger economies, in the Southeast Asian economies. There was a bust when the economy started to slow in 1995, 96. So China is quite aware of it, and therefore it does not want its property market to lift up too much. So irrespective of what happens to the interest rate situation in China, the Chinese administration would keep a very tight control on the property market. After 20 years of structural boom, the property sector in China has peaked. And I think we could have multiple years of slowdown in the coming years. Coming to India, I think there are 2 or 3 segments in India. The segment of budget housing where people want to buy for living, that demand will remain very, very strong. The interest rate, housing mortgage rates of 6%, 7% is very, very low. And even if it goes up next year, I think there's a latent demand for people to live in houses or upgrade from 1 BHK to 2 BHK or 3 BHK. That demand will remain, and that is the big story of India. That is the India story. But the demand for investing into the high value properties, bungalows, or large houses, that investment demand would taper off next year. If equity markets come under pressure, if rupee comes under pressure, there would be tapering in that demand, at least in the first half of next year. That demand would have a negative growth, in my opinion. But the undercurrent in the low income group demand for houses, that would remain pretty strong irrespective of the interest rates.
Thank you, Mr. Jaga. I would address this question to Mr. Gurumurthy. Mr. Gurumurthy, what would be your strategy as an investor this year in the metal sector? If I were an investor in the metal commodities, what should be my strategy?
Like as I said for lead, I said that when it goes to 2600, 2800, the exporters will have to look to sell hedge there, like they have to sell their exports. So it is so as I said, in the first quarter, the prices are likely to go up. So as it goes up, everyone has to be on the sell side, not. So this bounce in the first quarter could look like continuation of the uptrend, but it will not be like that. As it goes up in the middle way, it will stop in all the metal prices, and then it will again start to come down. So the first quarter bounce should not be taken. It will be a misleading factor for the broader market. Like it is going, the uptrend is still there, but that is not that will not be the case. Once the bounce happens from current levels, everyone should be start to sell the metals and should be on the sell side of the market only. So as I said, if I have to put it in terms of exporters and importers, exporters will have to be looking to sell their exports at higher levels, and importers can wait to buy their imports at lower levels.
Thank you, Mr. Gurumurthy. I have this question for Mr. Karmarkar. We have been talking about demand for the electric vehicles, but then there are other problems like high prices for lithium, because that is very key for battery making. How do you think that will play out with regard to copper?
See, copper, particularly on the battery chemistry itself, I would say it's still in a development phase. The second part is that the optimization of the battery chemistry is on the changing. I mean, is getting optimized very fast. Particularly when you say copper, the thickness of the copper plates used in, fabricating or assembling the battery with the solar cell, those thickness has gone more than half over last 3 years now. So the optimization of the metal usage is the one trend happening. Second thing you mentioned about the lithium per se. The lithium, I don't want to get into lithium prices because this is not my, subject. But the lithium in the chemistry, overall in the battery chemistry, is being looked very seriously. More as a critical material in terms of not only the prices, but also the sourcing part of it. So, various initiatives are there happening in R&D, particularly when you see in India, we don't have R&D base for battery technology. We have the battery assembly, which is done. The cells are still imported and we don't have. So we don't have to depend on the imported technology. And as far as the cost is concerned, the tapering down of the battery cost is the continuous process. And as a technology, the cost of battery technology is coming down compared to what it was for last 2 years. Today, if you see the battery packs which are used in the two-wheelers which are sold by Hero or TVS or many other entrepreneurs, those have come down at least by 20%. When they launched the product 2 years back, some of them when they launched the product 2 years back. So battery prices are coming down overall, largely due to change in technology and also optimizing of the material usage. On an individual per ton of lithium and all, I cannot say anything there.
Oh, thank you, sir. Mr. Daga, I have this question for you. We have been talking about metals heading higher. But what can really change the scenario? What about the likely impact of Omicron or any sort of geopolitical problem?
The geopolitical risks have played a very key role in determining all the commodity prices. We saw how the trade war between US and China in 2018-19 affected metal prices. The sanction in Russia pulled up aluminum prices, and all of these things do keep happening. Now, we are seeing a lot of geopolitical risk at the moment. One is Russia versus Ukraine, where the invasion of Russia on Ukraine could have sanctions put on Russia. The Europe and the US have been warning about it. Russia is a large exporter of nearly 4 million ton exports of aluminum out of the country, and that could have a positive effect on aluminum prices if those sanctions really come into play. Then you have some risks obviously relating to Iran, but I don't think that would have much impact on the metal prices. Omicron as such is not that big a worry, except the fact that China has a zero COVID policy. Now, even for one COVID infection, they can close down the terminals and ports, and that would have a disruptive effect on the supply chain of the metals yet again. So while other countries may take it lightly, but I think the way the Omicron is spreading, it is nearly doubling every day in UK, and after South Africa, and UK is becoming the next big country infected by Omicron. It could spread to other countries as well. Although the human casualty of Omicron could be low, but the governments could be worried about the spread and infection, and because of which there could be light restrictions on the industry. Yet, I would think that Omicron would not have large impact unless, just one exception, is that China starts to see a growing of Omicron, a spreading of Omicron in a big way. Then it may close down ports, it may close down factories, and that would affect supplies and as well as domestic demand badly. So that would have some, I would say, positive effect if they close down. The supplies are really bigger than the demand slowdown. That would have a short-term positive effect on prices.
Thank you, sir. Mr. Gurumurthy, what do you think will change the scenario of the outlook that you've given technically?
The scenario that could change is once the bounce happens in from after the fall that I had mentioned, if that bounce is going to sustain, then the second leg of fall, in the sharp fall that I had told that that can happen in the by the end of 2022 or 2023, that could change. But before that, I think on the charts, it looks clearly that we are going to see one sharp fall from here. And the bounce that is going to happen after that, that will need a close watch, whether that is going to be a consolidation or it is just going to be a rise and then a fall again. So that is where things have to be watched after the first fall. If that is going, if the scenario is going to get changed at that time, then we can see instead of another sharp fall, we can see a rise from that. But from the charts and from the price rise that has been very steep earlier, the chances are looking high for the price. And as seen from the commodity index chart, the cycle is turning down. So the fall could be a continuous one, like it is not going to stop. So the things might not change. That is what the feel is getting from the chart.
Thank you, Mr. Gurumurthy. And I have one final question to Mr. Daga as well as Mr. Karmarkar. I just want to have your views on, India was a net exporter of copper 2 years ago, but now we have become a net importer. Now, how do you see this impacting us and what could be the way out?
I think at the moment, in last 3 years, the closure of Vedanta smelter has had initially big shock to the consumer industry. But I think at the moment they have adjusted to the new reality. The imports have gone up. But if you look at it, the Indian demand is going to continuously expand. And as Mr. Karmakar said in his presentation, we see 8 to 9% annualized growth going forward. The deficit is only going to widen. So therefore, there is need for some domestic setup in order to fill that need. Otherwise, India, similar to gold or oil, would become highly dependent on the overseas market for its metal need. Now, the big problem is that India does not have rich ore resources, and because of which the margins in the copper smelting industry, in my opinion, Mr. Karmakar can differ, is not that good because you import the material, earn a TCRC of $60–70 per ton and 6.5 cents per pound. And then all the working capital expenses and other things becomes very, very costly. It's not the rate of return of investment is not that good. I think that's the reason probably despite this growing need of or growing deficit in the country, the new smelting capacities are not coming up. But I guess if you look at the Chinese model, China had an expansion of the smelting capacities. They did not have too much of mines, but they invested or they bought stakes in the overseas mines in order to stabilize the domestic supply situations. At the same time, they encouraged the domestic recycling industry. An organized way of collecting the scrap and then processing it back into value-added products or primary products. That is something that went up, and I think this is a model that even Europe and US are aspiring to do, and they have announced new environmental policies or new recycling policies for this purpose. I think for India that should be encouraged, but yet, I think that India, unless a new large smelter comes in, India would remain deficient. India would remain a net importer of copper in many, many years to come.
Thank you, Mr. Daga. Mr. Karmakar?
I will add to what Sandeep has said. The first point is that after the closure or after the issue started there in Sterlite, the transitionally all the supply chain was disturbed really. They were, but on some benefit to the supply chain was the FTA signed with Southeast Asia. So as a result of that, the cost advantage due to disadvantage due to import was not really there. So it didn't impact on a purchase cost of a buyer in India, but we as a country lost largely on a domestic value add. The buyer lost the flexibility of deliveries because of the imports, and in turn they have to start investing more, creating stocks and larger dependence on the trader overall, rather than the directly buying through the the smelter, which was the earlier supply chain equation. So there was definitely a loss on the buyer side, which is indirect cost, not on the direct cost, but there was a lot of indirect cost addition to the buyer side. And we as a country have lost definitely the foreign exchange reserves because exports were happening, the value add opportunity in the country, and then further value add due to the FTAs what we have, particularly with Southeast Asia. There's another side, which is the scrap side of it. And if you see today, even throughout the year, the import of scrap has increased, and that is basically to fill in the gap of the primary production. There are certain cost advantage because the recycling in the country overall is happening in the informal sector, highly unorganized sector. There are few organized recyclers, but recycling in Indian story for recycling is largely unorganized, and many recyclers. I mean, as per our analysis, there are at least few hundred recyclers in the country, and those recyclers are adding to the metal equation in an informal way, which creates the issues on the quality to a great extent, because definitely the recycling processes followed in the country cannot match with the recycling which is done by Arubis or the plants there in Europe. So we definitely have more work to be done overall in the copper recycling. Our recycling rates for the copper is also low. So recycling is, in today's copper supply situation, you can find a faster commissioning of new smelter happening very soon. But organizing a recycling is fairly a long-term objective. And today, the under Ministry of Environment and Forest, the circular economy from Niti Aayog, and then Ministry of Steel getting into that. There are some government initiative already has started, particularly for the non-ferrous metal recycling, which includes primarily at the moment aluminium and copper. But definitely recycling is the bigger piece of a metal equation, and we don't have any formal way of formal industry structure to consider that into our overall economy and metal equation. We estimate the total recycle number, the copper recycling, but this is still the estimate. If you see the primary data for recycling, it's very difficult to find out.
Thank you, Mr. Karmakar. It's been a very great session with you on the metals particularly, though we are bearish about the outlook. Now, I would invite Mr. D. Chandrasekhar, policy commentator and commodities market specialist, to give his closing remarks. So over to you, Mr. Chandrasekhar.
Thank you, MRS. It's such a delight for me to be part of this BusinessLine Commodity Market Outlook 2022. Let me start with a disclaimer. I have no trading interest. I'm not a trader. I don't hold any trading position either in the physical market or in the derivatives market. Now, until we started this event yesterday morning, until say Wednesday, okay, there were several questions in the minds of a large number of market participants around the world. They were all waiting for the US Federal Reserve. What is the Fed going to do? Will tapering accelerate? When will interest rate be hiked? Is there an upside for the USD and how much it could be? Is the fear of Omicron real or exaggerated? I think these are all questions that bothered a lot of people. And now, today, or in fact, even yesterday, we had answers to many of these questions. It is all very clear now. The US Fed will wind up the bond purchases more quickly. From June 2022, it's going to advance it to to March 2022. Therefore, it's going to accelerate. Number one. Number two, there'll be at least 3 rate hikes in 2022. Second quarter, third quarter, fourth quarter. And possibly, my sense is it will be a 25 basis point increase in interest rate, which will take the next year end, 2022 year end, to something like 90 basis points, etc. I think this is something all of us, those interested in commodity markets, have to bear in mind. This is a very significant announcement, significant decision for the commodity markets. But remember, many of these commodities had already discounted some of these factors, and therefore we have not seen any very major volatility in prices after the announcement. Now, we had a wonderful crude session yesterday morning, but while the technical presentation was very good, we didn't have some of those data points from a fundamental perspective, which I am now going to provide primarily. Brent crude in the last 1 week, that is today is Friday, from Monday onwards, has lost already $4 a barrel. It was trading yesterday at about $72 a barrel. WTI has dipped even below $70 a barrel. There is a very clear possibility or prospect of oversupply of crude oil in 2022. And therefore, there are renewed demand concerns also. Therefore, with prospect of increase in supplies and demand concern, it's a very clear opportunity for the market to start correcting, and the correction is already started. And the International Energy Agency has actually revised its demand forecast down by 600,000 barrels a day, which of course contradicts what the OPEC had said a day or two earlier. But the IEA numbers are going to prevail in my view. Therefore, 2022 set for a significant oversupply as far as oil is concerned. The supply growth is likely to be 6.4 million barrels per day, while the demand growth is going to be lower at just about 3 million barrels per day. And therefore, that is what is going to impact the market. And therefore, the OPEC will have to rethink. And my own outlook suggests that going into 2022, crude oil will certainly break below $70 a barrel. Brent will break, and it could trade between $65 and $70 in the first and second quarter of 2022. Then we had the agri session, where also we had numbers relating to sugar, but I didn't see numbers, data points relating to vegetable oils. And I'm going to share very quickly some data points as far as vegetable oil markets are concerned. 2021-22, global vegetable oil production is going to be up by 9 million tons, whereas consumption is going to rise only by 5 million tons. This increase of 9 million tons will be contributed by palm oil, an increase of 3.5 million tons, sunflower oil, an increase of 3 million tons, and soybean oil, an increase of 2.5 million tons. And therefore, the market is going to be in surplus. And with this surplus, the markets will have to correct. And the signals for correction have already started. And you know how the BMD prices have started to decline over the last 2 or 3 days, and they are decisively below 5,000 Malaysian ringgits a ton, and I think it's likely to fall further. With crude oil falling and with the vegetable oil prices under pressure, is a great recipe for people with discretionary blending to actually rethink or review. Mandatory blending, yes, will continue, biodiesel blending, but discretionary biodiesel blending will obviously rethink about the market. And India is such a sensitive market as far as vegetable oil are concerned. We are the world's largest. Our own demand growth is quite tepid because of high prices and falling rupee, basically. And what is also important is our Rabi crop. Rabi crops are looking good, particularly the rapeseed mustard crop can hit actually a record Therefore, I'm expecting a 20% decline in global vegetable oil prices, including palm oil prices. And this correction will happen in Q2 rather than in Q1, because Q1 is a lean season for palm oil production. Production will start increasing of palm oil from April onwards. Therefore, expect this correction. Cotton, yes, very, very clearly, production is going to increase. Consumption is also going to increase. But consumption in 22 is going to be slightly above production, which is going to create a decline in the end stock of cotton for 2022. And therefore, the markets are already upwards of 100 cents a pound. And therefore, I expect the market to stay firm, cotton global and Indian cotton market to stay firm, certainly in the first quarter of 2022, primarily because of pent-up demand. And after that, planting intentions and US planting intentions and India's own southwest monsoon forecast will come into play. And very clearly, higher prices are going to encourage higher planting and higher production in the northern hemisphere in the second half of 2022. Bullion, we had some wonderful discussion this morning. Gold started with a bang early this year at $1,950 an ounce. But after that, recently it's struggling to decisively break about the $1,800 barrier, which is, and with the US Federal Reserve's announcement, with accelerated tapering and the prospect of an interest rate hike, my sense is gold will continue to stay under pressure. Unfortunately, I'm not able to persuade myself into believing that gold will go anywhere near $2,000. In fact, in the first half of the year, gold is certainly likely to be under pressure. In the second half of the year, I'm expecting a slight upward momentum, but year-end price for me for 2022 year-end most likely will not be above $1,900 troy ounce. Silver, on the other hand, has a fantastic upside, extraordinary industrial demand for silver with the electric vehicles, solar capacities, expansion, etc. And therefore, silver has a significant upside in my opinion. And silver market is potentially getting into a deficit situation. And therefore, strong industrial demand is going to propel silver prices. Base metals, our friend Sandeep Daga gave a wonderful presentation. This is nothing but China, China, China. It's all a Chinese story, and China is set for a slowdown. The signals are already very clear. China had very high import numbers in the month of November, but a lot of people get carried away by those numbers. I think these numbers are misleading. There is a cut in the required reserve ratio by the Central Bank of China, but that is actually more to cushion the downturn in the property market. Obviously, the MRS referred to the Evergrande developer issue, which is bothering Asia, which is bothering China. Now, environmental issues and energy challenges are also issues that China is facing, and they are not going to be able to get over these challenges fast. And in China, all of us know in the last 5 years is moving gradually away from fixed asset investment to consumption-led growth, from investment-led growth to consumption-led growth. And therefore, that's going to impact metal production and metal demand as far as China is concerned. We have the latest numbers. Stainless steel production cut is going in China will certainly impact nickel. Slowing galvanized steel production in China will impact zinc, etc. And then our friend Gurumurthy showed a wonderful chart talking about how these metals market is going to face a definite decline. I think this is the emerging situation as far as 2022 is concerned. Wait for lower crude prices, wait for lower vegetable oil and cotton prices. wait for lower base metal prices and possibly a very ranged gold market, but a slight upside or a definite upside for the silver market. I think this is a kind of outlook that we are getting overall from all the speakers and from my own analysis. So I thoroughly enjoyed participating in this. Good luck. God bless you all. Stay tuned. I would think BusinessLine should make it an annual event. It should become a calendar event every year so that investors would know what is the outlook for the following year and they'll be able to make their investment decisions. I will stop here. Good luck. God bless you all. Thank you.
Thank you very much. A very insightful in outlook that you have had, and we hope that things will pan out as we are making the projection. Most likely it will turn that way. Unfortunately, we have to wrap it here as we have run out of time. But it was a wonderful session both 2 days. We have had wonderful sessions, very good exchange of views and foresights and projections. So until we meet at the next webinar that BL could be coming up with. Bye for all. See you.
Thanks.
Thank you.